Hello, ladies and gentlemen. Welcome back to another episode. This is your host, David Kim.
So Lipa means pay in Swahili.
Swahili. Pay later.
Yeah, it's a Swahili. Yeah, exactly. So it's essentially pay later. So around, if you're walking around East Africa, the word Lipa Later makes a lot of sense and it's very straightforward. But it's essentially pay later, which is our offering. So, buy now, pay later.
Why don't you tell us a little bit about yourself, your background, your journey to the founding Lipa Later?
Yeah, so about myself, I'm Kenyan, raised in Nairobi for the most part. I went to school locally, and then I ended up going to the US for university. I went to a small entrepreneurship school called Babson College.
Babson College in US?
Yes, do you know it?
Everybody knows that school except for you.
Let me tell you, in Nairobi, not many people know about it. Yeah. People think I went to a community college, but it's
that's
actually
the school of entrepreneurship, right?
Exactly, it is. Yeah.
Right.
So I went there for my university program. I did my 4 years there. Graduated with a finance degree and a marketing degree as well. And then thereafter, I came back to Nairobi, moved here. So that's a little bit background for me. But then I came back from school. I was 22 years old when I came back. In around 2015, when I came back from school from Babson College, I was really not sure what I wanted to get into. I knew I wanted to do something with finance. I knew I wanted to do something around enabling people to access credit, but I also knew I didn't want to become a banker. So it was kind of a very tricky situation when I came back to figure out what my passion was and what I wanted to do. So I ended up doing a lot of different entrepreneurial projects. I started a security company that did pretty well, but it was very boring for me at the time. And then, I got involved in a cleaning company as well. So just doing a bunch of different projects that eventually ended up leading me towards Lipa Later. And essentially what happened there is that I noticed with a lot of the people that I was working with, a lot of my friends, a lot of my family, we all had a very similar problem that had already been solved in the West. And that problem was just simply, access to credit, access to devices, access to items, and just lack of adequate purchasing power to buy these things up front. So essentially that's where the idea of Lipa Later came from. So I was just okay, look, if everywhere else in the world people can shop and buy phones and pay for them over 36 months or 48 months, then in Africa we should be able to have the same opportunity. And that's literally how I came up with Lipa Later, and we started running from there.
Yeah, this is actually quite popular and the proven business model in other part of the world as well. I have seen a lot of startup and non-bank finance company came up with this idea.
Right.
So solve the problem and help the underserved consumer to have access to this kind of credit, right?
Absolutely. Yeah, it's clearly something that really, picked up in other markets like Asia, Europe, obviously the US. Africa has been left behind a little bit, but that's why we're here to help us catch up and do this at scale.
What is your business model exactly? Are you providing e-commerce service beside installment to consumer credit?
Yeah, I think I'll answer that question by also explaining what are the problems I think we're solving, and also then I can talk about the model at the same time. So we solve three main problems. One is for the consumers. For the consumers, the problem that they have is access to credit, and the fact that they have also a very limited purchasing power. That's the major problem we solve for consumers. So access to credit, we have our back end credit scoring and machine learning algorithms that will credit score our customers, and with that will enable a lot more people to access the right kind of credit that ordinarily they would not be able to. And that in turn, because of the way we give our credit and we don't necessarily give cash to consumers, we pay the retailer directly. Essentially, what that means is we're increasing the purchasing power for our consumers. And the way we monetize that is that we've allowed our consumers pay us an interest rate. So that's our first way that we generate income, and one of the biggest problems that we're solving on the consumer side. On the merchant side, the next problem that we solve two problems. One is that we take the pain away from the merchants, from them having to give credit to consumers. Obviously that's not their main business. That's not what they're set up to do. So we take that away from them, and we give that to them, and this allows them to increase sales and so on. Yeah.
Yes.
For the most part, what that enables us to do is charge merchant commissions. So largely, another part of our revenue model is we charge the merchants commission. Exactly. Based on the sales that we deliver to them. Lastly, on the merchant side is that in the market we operate in, it's significantly different from the Western markets and possibly even in the Asian markets, because of the fact that a lot of the merchants are still still offline, still very brick and mortar. While we do have some that are fully digital, there's a lot of them that are not. So we then decided to create a marketplace, and our marketplace basically serves as a platform to connect both the merchant and the consumer. So online. So we took all our different merchants and brought them online, and we do all the fulfillment for them, the management of the platform for them, and our consumers can then come there and shop and use Lipa Later as a payment option. So if we look at that, essentially how we describe ourselves is as a platform for both the merchants and the consumers that allows them to shop and sell items in monthly installments. So that's essentially what the business does.
Yeah, I can feel that you have solved a lot of problem on the merchant side and the consumer side. So you can bridge and connecting them to make a transaction happen, right? Basically. So
Correct.
Yeah, but this model, I don't know the exact structure of the services to merchant and consumer, but I actually personally in previous career I managed a lot of leasing company, installment credit finance company in Asia. So you can evolve and grow in many different directions, and then repackaging your services in a many interesting way. Especially in Africa, is people don't have cash, right? Then this could be a very, very efficient solution for them.
And how was your leasing experience? Did you what was your what are your takeaways from your time as in the leasing business?
That's a very big question. I set up the many leasing company. Actually, first 15, 20 years, basically we are invited. I work for the Korean government bank, development bank, and we are invited by the Asia Development Bank and IFC World Bank. There's one of the initiative is mandated setting up the non-bank finance company, leasing company in emerging and frontier market, because their assumption is that banking system doesn't work for frontier market because they are having exactly same checklist, exactly same the credit reviewing the template as a bank in the Wall Street, right? Then you ask the same question to the SME in the Nairobi or the rural area in Kenya, then they don't have any information to provide for that template, right? Also, later banking officer, credit officer will ask you whether you have collateral because you don't have enough credit, but you don't have collateral, right? That's
exactly.
That's the way. Also, the other issues idea, ADB or IFC or bank, they came up with a leasing initiative is that if the bank give the money to the entrepreneur and business owner, you may use the money for different reason, right?
Or something else, exactly.
Something else. They made a speculation in the land and buying the apartment, luxury housing instead of building a new factory, right? So if you provide a lease financing, like what they call the asset financing, right? They cannot repurpose the money for the different reason, private reason. So that's the way they came up with, let's set up a lot of leasing company in emerging and frontier market to help the SME and small company. That's the way I was involved in setting up the leasing company, joint venture leasing company with the local banks, then the installment financing company in Thailand, Vietnam, China, Nepal, and many different countries. So basic idea is similar. Better to use than own, right? You have to use it, right? That's a
Exactly.
basic. That's a. I mean, owning something has a lot of pain as well, right? If you buy the luxury, I mean the remote island, the Bahama, I mean something, you have a lot of maintaining pain, right? You need to hire people clean it, but if you use it, you don't have that pain, and that's a basic idea. So, but it can evolve in many different instructions. You are in substance pretty much leasing and or the installment credit, whatever you call in substance quite similar, but important thing is a provider, they think the financing, but on the user side, consumer side, they perceive the different way, many different way, right?
Exactly.
So they don't, some people don't even perceive it is a financing or installment credit, but they think that this is a service provided by the Lipa Later, right? So,
Correct.
but so that's the way. I mean, you can evolve your business model in many different direction and the repackage it. So consumer feel that it is a very convenient solve the many problem, but they don't need to understand whether your service is a financing or not in substance.
Absolutely, and I think like that's one of the key things that we're trying to like work on and package our product to, in that direction, for it not to appear as call it as a loan or you know, things like that. It's more of, you know, like we're just facilitating a purchase, like we're allowing you to
Service.
Exactly. Yeah.
And then, do you have a co-founder?
I do have a co-founder and a few very early team members. Yeah, my co-founder is a long-term friend. Like we went to high school together.
I see.
Yeah, knew each other very well. So he's my co-founder.
Okay, got it.
And then,
so how did you come up with the business idea, and how long did it take for you to you with your co-founder agree on the plan to launch the business?
I would say from the day of which we were now ready to, like, not ready, I would say the day we had actually conceptualized the idea. First of all, from the day it came to my mind to the day we put it down on paper, kind of like thought about it, brainstormed, asked a bunch of people how if this idea makes sense or not. That probably took us like 6 months, I would say, to get to that point. And there was a lot of hurdles because even just in like the conceptualization stage, we you know, the product did not exist in anywhere in our region. So it was more of a lot of naysayers that were speaking to the merchants.
I can imagine.
You know what?
You are surrounded by a lot of naysayers, right? Smart people, so accountant, lawyer, finance guy, right?
Exactly. And everybody's telling us like, you guys are idiots. Like, this is not going to work. You know, like, and so on and so forth. So, you know, like, why don't you just give a loan? Why don't you just, like, the microfinance banks are already doing that, and so on. And then I remember even like before we actually even went live, one of the banks like rolled out a product that eventually failed called Loans for Phones. So that whole process was about 6 months. And then eventually, like, my co-founder at the time had a job. He's a lawyer by profession. And also studied finance as well. So he had a full-time job. So he eventually decided like to quit his job and, like, you know, very bold move, and then to join me and like build this. So that was, you know, I guess I want to say like 6 to 9 months after we had already like conceptualized the idea. And then, you know, he came in with a little bit of his own personal savings from his job. And then we started like very naively, not really knowing what we were getting into, to be honest. because I think the naivety was very good at the time because it allowed us to just get started. But once we got started, we realized that it's not as easy as we thought. And then the building really began. Yeah. So that I would say from conceptualizing about 9 months, and then initially it was a lot of bootstrapping ourselves. Right. Also, like we didn't really we were just like kind of like doing everything ourselves. We convinced 2 other people to join us as like our initial like team members, and then a lot of the money we'd initially like just started raising was we just took a bunch of loans from our family and friends to get started, and essentially like that's where we began.
Okay, got it. But still, you talk about credit scoring, right? But do you have a lot of, experience and background in the like consumer financing or credit side?
Personally, like not really, but the experience that we have as a team largely has been based on the experience that we've gone through ourselves. Largely. Now, of course, we've built a team now that is very experienced in data science and credit scoring. So we have definitely a strong team that understands that.
Like a credit scoring, credit reviewing, portfolio management, that's a very simple, easy to understand word. But how do you actually manage the credit scoring and then measure that? And how do you manage that? Because are there enough information about your customer, individual customer?
It's what I would say has evolved over time. So like in the very beginning, it was a lot of manual things that we were doing. And there was also a lot less information about customers when we started out. Now things have definitely changed. There's a lot more data that we can get on customers. Before we couldn't like even verify people's identity. We could barely do that. The credit bureau data probably was not as ripe as it is now. It still has a long way to go, but it's a lot better. So there is definitely some significant improvements with regards to like the access to data that we're able to get in our different markets. So that's number one. Then on our end, what we realized is that the traditional way we obviously could not do it in the traditional way of credit scoring and so on and portfolio management because the traditional way was not working for most people anyway. So we needed to look at it differently. And the way we looked at it was like we had to like basically create our own kind of scoring algorithms, which we then like kind of built. So we look at thousands of data points for each customer that comes in before we're able to issue a credit decision, and all of this happens in a matter of seconds. So within like 5 to 7 seconds, we're able to issue either a credit decision that's positive or negative for a consumer. And if it's negative, we typically try and work with the consumer to see what we can do to make that a positive. Some consumers we can't just offer credit to, but largely our algorithm is built towards giving it a positive decision. And then that's just one part of it, because the other part of it is now the collection process, which, as you mentioned, portfolio management. It sounds like a simple word, but it's very difficult.
Yes.
So we were lucky to have a very strong team, find the right people very early on with this, and we got people who are like very experienced on the collection side. So we set up our own. We noticed that a lot of people had external collection, call it like teams. So we decided to set it up internally. Which I think in hindsight was a very good decision, because we've built collections and portfolio management into our culture, which has allowed us to maintain a very healthy portfolio. So that's that's kind of like what we've done on our end. And one of the good things we have is also the technology to lock devices where someone defaults and so on and so forth. So that's essentially our portfolio management and collection strategy as a company.
Got you. Next question is, what is the biggest challenge in the scaling your business, taking to the next level? Is it the skill, the talent, lack of the skill, the talents, or money, sales and marketing? Anything you feel that you are lacking now?
Yeah, so I would say like the biggest challenge is access to capital, because the demand definitely supersedes the supply in our business significantly, right? And the nature of, like, call it the capital instruments that exist in our markets are significantly different from what would exist like in Australia and in Asia and in the West as well.
Right.
So,
Right.
That's like the biggest thing, like getting like, working with financial institutions to be able to meet that demand in a call it like, I'll say, fast period of time is very difficult.
Yes.
Of course, we've made good progress and so on, but I would say that has been the biggest, challenge as a business to meet that demand.
Got it. Bank is much less sophisticated, or the the diversity of non-bank financial institution and services is very limited. Also, they are not well developed compared to the large and developed economy. So then is quite difficult to raise money, finance it. I heard from another guest, like who are running the second-hand market, second-hand car trading, like Car 45 and what is that? The Auto Check and the large player in Africa. They said that only 1% of a second-hand car are financed by the financial institution in Africa now. 1%. But,
Wow.
yeah, I can imagine that number probably in East Asia, relatively developed Asia economy, probably 70-80% or more than that.
Wow.
So people don't usually people don't buy the car whether it is new or the old. They don't draw down the money from the bank account, pay money up front. They use the installment financing. So it sounds like a huge challenge, but I also think that the huge potential for your business in Africa, right?
For sure, and it's another challenge. You see, it's a challenge that has to be overcome, obviously, but doing business across Africa is also very difficult. So, there's so many different barriers that already exist.
Yeah.
Like regulatory barriers, language barriers, and all those things. So,
even language barrier.
Yeah, for sure. Because even in East Africa alone, there's
English
a language
doesn't
barrier.
work.
Not like, for example, like in Rwanda, there's a language barrier. Not many people speak English. They're trying to get there, but
I didn't know that. I thought every African speak fluent English.
No. Even we find there's Francophone Africa as well. There's like the
Francophone Africa. Yes, true. Yeah.
So, but so those are it's just also like the opportunity is massive, and also, also why the opportunity is so massive, I think, for us is because like nobody has really been able to do it across the entire continent as
you are the first. You're the first mover. Right?
We want to be, at least we want to be that person that can that company that can scale across multiple markets at the same time.
Probably only one major key issue: how quickly you scale up before the competitor shows up, right?
Exactly.
And then probably if you quickly scale up the business, probably other competitors don't even think about entering this market.
Exactly. Yeah.
Okay. Let me ask an interesting question. Assuming that I'm the investor, I'm very interested in the African market, especially your business model, because I have a finance investment background. I want to make a big bet. Like, I don't know how much is big for you, but let's say 10 million, 15 million US dollar. Sir.
Yeah. So I think the first thing that we would need to do, like, for us, we already know like where the majority of the, call it, pent up demand already is, right? And it's in the field that we're already playing in, which is electronics and furniture business, and generally which is retail as well. Yeah. So we would of course want to enhance our technology. We're looking to make sure people can access our facilities faster, can access a lot more merchants, because one of the critical parts of our business is just being able to have a lot more merchants. So if we can have very many merchants, it offers a lot more variety and it extends our reach. And for us to be able to do that, obviously we'll need a lot of capital injection to come in, and that's what we would probably do with it. Number two is geographical reach. So as I mentioned, like, we're looking at being a Pan-African business, a continental business. And for us to do that, we've identified the key markets that we need to be in. spread across the continent. So one is Kenya, which we're already there. Another one is Uganda, which we're going to be launching in April. And we'll then look at Nigeria, Ghana, and Cote d'Ivoire. Those would be our next frontiers, because we've looked at what the retail market looks like in those countries, what the nature of the economy is, and the kind of people that are there, and those will be our next frontiers. So we look at one, as I said, merchant acquisition, acquire a lot more merchants. Two, building out our product to essentially just be able to provide our services a lot faster and allow people to use us for everyday services as well. And then lastly is a geographical kind of expansion. That's like how we're looking at what we would be doing in the near future with, call it, extra capital coming into the business. Yeah, so I'll just, like, if you look at our business model, like the market, we consider ourselves playing in the retail market. So the retail market is obviously very huge. If you look at numbers across Africa, we're looking at values over $500 billion, but I'm not going to talk about those numbers. If you look at now, if you narrow that down to East Africa, and you look at what the value of electronics alone in the retail business, which is our main thing that we finance, it's a $5 billion market a year. So that's electronics. So we're talking mainly phones, laptops, TVs, and so on, which amounts to about 40% of our 40 to 50% of our portfolio. We, on average, believe that we can extract out of the total market an additional 10%. So this additional 10% is essentially unlocked through enabling customers to shop with credit. I think 10% is lowballing it, but if we say 10%, we're looking at about a $500 million business a year. So that, and these are numbers I'm referring to just in the East African, call it, context of things. So the market is huge. Now, if we start talking about adding in, furniture numbers and all those things, and now looking at it at a continent kind of level, it's a very big market.
I agree with you, because in the frontier emerging market, based on the consumer story, right? Growing consumer story, consumer population. And usually like corporate finance, structured finance, project finance, it sounds like fancy, but they don't make money because the credit is very complicated and difficult to manage. But usually consumer financing company, as just like what you're doing, is usually they are quickly scale the business and also much more profitable than the corporate financing. Yeah.
Exactly.
Okay. I think this is the end of the question. I thank you so much for taking time. I really enjoyed the conversation. I hope that we have a chance to meet in person someday in the future in Africa.
I hope so too. I really enjoyed the conversation. And you said you have been to Nairobi, right?
No, I've never been to Africa. I'm the now what you call is virtually navigating every country in Africa now. Virtually. So thank you very much for listening to this episode. Don't forget to subscribe to the podcast, share with a friend, and drop me a review. Goodbye.